In this video, we're going to talk about Vinco Ventures, trading under the ticker symbol BBIG. Vinco operates in the consumer products and digital marketing sectors. Its most important asset is a social media platform for video streaming in the Indian market. It has been one of the more popular stocks and platforms, which is expected to fill in the local demand in one of the largest markets in the world. It has a good narrative because of the video platform and because it is in the middle of a short squeeze between those who want to push lower the stock and those who want to squeeze out the short sellers. The company was founded in 2017 and is based in Pennsylvania. The trading volume of Vinco Ventures has recently been around 200 million shares a day, compared to the average volume of around 30 million shares over the past 30 days. The trading volume of Vinco Ventures has recently been around 206 million shares compared to the average volume of 28.6 million shares. Over the previous 52-week period, its price fluctuated between $1.40 and $12.49. The market cap of Vinco Ventures is currently at $558 million compared to an enterprise value of $362 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncomfortable about lending the company more money or putting more money in its equity because the company may have difficulties paying back this amount, which in turn may negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for some growth-type companies. For many of them, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the market is able to generate more profit or to have more growth than other companies, partially because it may have a good management team, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value the market gives to its assets when the debts are paid off. In comparison to its historical price fluctuations, the stock is 88.4% higher than its 1-month low, 88.4% higher than its 3-month low, and 190.7% higher than its 52-week low. In terms of options market, which often gives a hint on what people think where the stock price is likely going to head toward, the implied volatility is 230.2% compared to a historical volatility of 135.1%. The put-call volume ratio is currently at 0.2. The most recent volume of options traded has been 502,000 contracts within a day, compared to the 30-day average volume of 89,000. In terms of open interest, the most recent volume of open interest has been 1.1 million contracts, compared to a 30-day average of 926,000 contracts. In terms of its shareholder structure, institutional shareholders hold about 13.5% of its outstanding shares. The biggest shareholders include Nomura, Bluefin, and Hudson Bay Capital. The relevance of the shareholder structure is important to determine whether you should be holding the stock long-term or to view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Obviously, there are a lot of exceptions from what I said above, but usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Let's also look at the short interest present in the stock, which is the amount of positions that aim to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, it could be a sign that there is an organized shorting operation going on, like what has been going on with GameStop, AMC, and arguably Vinco as well. The current short interest is 22.6% of the total floats and 55.5% of the dark pool transactions. In other words, this means that most of the short orders do come from the institutional side. Now, let's also take a look at the indicators. Financial indicators give us a hint or a suggestion of where the price movements are going and what they are showing, and they can be used as one of the elements that determine our overall approach. The oscillators are showing an overall tendency of buy, and the moving averages are showing an overall tendency of strong buy. The moving averages can be used to determine if the stock is overbought or oversold in the short term, which can be used to see if your trade is sufficiently well timed. Regarding the pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $1.55, $2.15, and $2.31. For the resistance levels, they are $3.26, $3.55, and $5.27. Looking at the stock price of Vinco Ventures over the past few trading sessions and actually over the past few weeks, it seems like the share price has found some solid support and has since then bounced back significantly from where we covered it last time. The market participants are willing to believe in the eventual tide reversal at the end of the short squeeze, which is why we should never rule out this scenario despite the fact that right now, even now, things are not looking that good for this company. My overall opinion regarding Vinco Ventures has now changed to bullish because it has now demonstrated that retail traders have not abandoned the ship just yet, even if the stock remains under significant selling pressure. There is always the risk that during the upcoming trading sessions, the market may not provide enough trade volume for Bbig to go up. So that'll always be a risk for any short squeeze situations. So definitely keep that in mind and price it as a factor in your positions. Over the past few trading sessions, the stock has managed to climb around $4.50, which means that a support has been identified around $2.40, meaning that there is a true potential and possibility for a trend reversal from here onward. My recommendation is to make sure that your exposure on Vinco Ventures remains at a maximum of 1% of your portfolio, and that right now it seems like a good entry point to consider. I would say that the previous peaks over the past few months is between $5 and $10, and that is a good place to look for like potential profit targets. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks been shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.